How much money do you actually need to become a private money lender? You might think you need hundreds of thousands or even millions of dollars sitting in the bank before you can start lending money on real estate, but that's not necessarily the case. I've personally used different sources of capital to make private real estate loans, including money from a self-directed IRA. And depending on how much capital you have, there are different ways you can participate. But there's one really important catch. The less money you have available to lend, the more important your underwriting becomes. So in this video, I'm going to break down how much money you need to actually get started, what your options look like at different capital levels, and the different things I look at before I lend a single dollar. First off, if you're new here, hi, I'm Andrea. I'm a pharmacist turned real estate investor and private lender, and I create content for W-2 professionals who want to build wealth and additional income through real estate without necessarily taking on another full-time job. If you're interested in real estate investing, private money lending, and creating more financial flexibility while you're still working your W-2, make sure you subscribe. I talk about that every single week. So let's start with the question. What exactly does it mean to be a private money lender? At its most basic level, private money lending is pretty simple. A real estate investor needs capital to purchase, renovate, or otherwise improve a property. Instead of getting all that money from a traditional bank, they borrow it from a private individual or private lending company. The borrower gets the capital, the lender receives interest, and the loan is secured by real estate. So if you're the person providing the money, you're essentially acting like the bank. And that's actually a really helpful way to think about private lending in general. Because if you've ever gotten a mortgage, you've already experienced the basic concept of lending. You borrow money, you agree to repay it with interest, and the property serves as the collateral for the loan. Private lending follows a very similar basic structure, but there are some important differences as well. When you get a traditional bank loan, you're working with an institution that has an entire system built around underwriting risk. There may be different loan officers, underwriters, appraisers, attorneys, risk management departments, and standardized lending guidelines. The bank has a specific set of criteria that determines who qualifies for a loan and what they're willing to lend on. Private lending can look very different. Instead of a large institution providing the capital, you're the individual or private entity deciding whether you're comfortable making the loan. And that can give much more flexibility to you as a lender. You can evaluate the specific property, you can evaluate the specific borrower, you can negotiate the interest rate, you can negotiate the term, you can decide how much you're comfortable lending, and you can decide whether you want to make the loan at all. But that flexibility comes with responsibility. A bank has an entire underwriting system behind its loan. As a private lender, you need to understand what you're actually lending against. And as a lender, one of the first things I want to know is, where am I in the capital stack and how much total debt is sitting ahead of me? Because your loan amount by itself doesn't tell you the entire risk of the deal. Let's say you have $10,000, $20,000, or $25,000 that you'd like to put to work. Can you become a private lender? Potentially, yes. But you need to understand that having a smaller amount of money available may affect the types of loans that you can participate in. For example, let's say that you're looking at a fix and flip that needs $300,000 of financing. You only have $25,000 available. You may have the opportunity to put your $25,000 into the deal, but you may be coming in behind another lender who has already provided the first $275,000. So now you're in a junior position. You're not in the first position or senior position. And this is where I think it's really important to understand that the amount of money you're personally investing doesn't necessarily tell you the entire risk you're taking. If you're investing $25,000, you need to know what the total debt against the property looks like. Because if the property is worth $400,000 as is, and there's $300,000 or $350,000 of debt against it, it's an entirely different risk profile than if there was $200,000 of debt. So if you're starting with a smaller amount of capital, I would spend a lot of time learning how to underwrite the deal. For example, in a fix and flip scenario, I want to understand the property's as-is value and the total amount of debt, including senior positions, to mine. As a general framework, I want the total leverage, so not just my money, but the total amount of debt to be well below roughly 75% of the as-is value. So let's use a simple example. Let's say the property has an as-is value of $400,000. 75% of that is $300,000. If there is already $250,000 in senior debt and you're considering lending another $25,000, the total debt would be $275,000. That's below the 75% threshold. That cushion will protect you in case of a default on the borrower side, where you need time to build in holding costs, additional fees, attorneys, and potential foreclosure. Now, this isn't a universal rule for every loan and every single real estate example. It's just an example of a type of underwriting framework I use when evaluating risk. And the point is that if you're going to start with a smaller amount of money, you need to understand the entire capital stack. not just your piece of it. The other important thing to consider is different locations of loans. You may be able to find a $25,000 first position loan in the Midwest on a rundown property that would actually work. However, in California, the odds of you finding a $25,000 first position loan are very, very low because property values are high. So take that into consideration when you're thinking about where you're lending. I primarily do my lending in the Southeast, and those property values are higher than the Midwest, but they're certainly lower than the West. Let's talk about the other question people usually have. How much money can you actually make when you're lending? Let's say you lend $25,000 at an illustrative 10% annual interest rate. That's $2,500 per year, or about $208 per month if the loan were outstanding for a full year. You might look at that and think, well, that's not going to replace my paycheck. And you're totally right. But I think that's sometimes where people misunderstand the beginning of private lending. Your first private lending deal probably isn't going to create life-changing income, probably not the second one either. The bigger opportunity is to learn how to do this well, getting your capital back and then redeploying it. If that $25,000 comes back to you after 6 or 12 months, you can potentially lend it again and then again. And that's where compounding starts to become much more interesting. You can also add to it, right? As you're making more money, as you're saving money, you can then put that into your private money lending as well. So that can begin to compound. So what about if you had $50,000 available? Once again, at a potential 10% interest rate annually, that's $5,000 per year, or approximately $417 per month. Again, the real return depends on the actual loan terms, how long your capital is deployed, whether there are fees, and whether the borrower pays as expected. But having $50,000 can start to give you more flexibility, and that's the amount I actually loaned on my first position deal. You may be able to participate in larger loans. You may have more opportunities to diversify, and you may have more ability to be selective about the deals you take. And that last part is really important to me, because one of the biggest benefits of having capital available isn't simply that you can make more money. It's that you can also say no if the deal doesn't fit your strategy. Some of the best deals I've made have been deals I've decided not to invest in. And having capital sitting on the sidelines gives you the opportunity and the ability to wait for something that actually fits your criteria. So what about $100,000? Now let's say you have $100,000 available to lend. At 10% annually, that's $10,000 per year. And as your lending capital increases, your options can increase as well. You may be able to spread your capital across multiple loans. You may be able to participate in larger first position loans. You may have more flexibility to keep some capital in reserve while still having money deployed. And you can potentially become much more selective. That's one of the things I really like about private money lending. You're not necessarily looking at every single deal and asking, how can I make this work? You can start asking, does this deal meet my lending criteria? And that's a very different position to be in. So where does the money come from to begin private money lending? Now, here's something else I want to clarify. When I say that you need $25,000, $50,000 to lend, I'm not necessarily talking about having that exact amount sitting in your checking account. There are different sources of capital that investors may use. Obviously, one is cash in your checking or savings account, but I've personally made private loans using money from a self-directed IRA. A self-directed IRA can allow you to invest retirement funds into certain alternative assets, including private real estate loans, depending on the account structure, custodian, and applicable rules. So the question isn't necessarily how much cash do I have in my checking account, it's how much capital do I have available to invest and what is the most appropriate way for me to deploy it. And I think that's a really important distinction because someone could have $100,000 sitting in a retirement account but very little cash available in their checking account. That doesn't necessarily mean that they have no capital to invest or lend. It just means that they may need to understand their options for accessing and deploying that capital appropriately. And that's actually a topic I could do an entire video on and have done an entire video on because there are some important rules around using retirement accounts for private lending. Definitely check that video out if you have any questions. Now, the money isn't necessarily the hardest part, because what I really want you to take away from this video is this. The hardest part of becoming a good private lender isn't necessarily about accumulating the money. It's learning to evaluate the risk, because you could have $25,000, you could have $250,000, you could have $2 million, and you could still make a bad loan. Before I lend money, I want to understand several things. First, what is the property worth today, right now, as it stands? not what I hope it's going to be worth after the renovation. What is it worth right now? Second, how much total debt is against the property? And where does my loan sit in that capital stack? Third, who is the borrower? What's their experience? Have they successfully completed projects like this before? Fourth, what's the exit strategy? How am I getting my money back? Is the property being sold? Is the borrower refinancing? What is the plan? And finally, what happens if things go wrong? What happens if the renovation takes 6 months longer than they expect? What happens if the project goes over budget? What happens if the property sells for less than expected or sits on the market for a very long time? Those are the questions that matter. So how much money do you actually need to become a private money lender? There's no magic number. You can potentially start learning and participating with 5 figures, but having less money available can limit your options and may mean you're participating in more junior positions, which can carry additional risk. As your available capital increases, you may have more opportunities to diversify, participate in larger loans, potentially take first positions, and be more selective. And regardless of how much money you have, the most important skill is understanding the loan you're making, because I would much rather have $50,000 and know exactly what I'm lending against than $500,000 and make 5 loans that I haven't properly underwritten. If you're a W-2 professional who wants to learn more about private lending and how you can use real estate to create another source of income, subscribe to this channel. And if you'd like me to walk through an actual private lending deal from start to finish, including the property, the borrower, the loan amount, the position, the underwriting, let me know in the comments below. And I'll see you in the next video.